morning and welcome. I'm Mackenzie Babb, External Affairs Director for the Kenan Institute of Private Enterprise at UNC Kenan-Flagler Business School, and I am pleased to welcome you to How Far Will the Fed Go?, the second in our new series of monthly press briefings that we're offering on the state of our economy. This and future press briefings on the topic will coincide with the release of the Labor Department's monthly jobs report, which typically falls on the first Friday of the month. Today's conversation will be led by Kenan Institute Executive Director Greg Brown. I'll be handing things over to Professor Brown here momentarily, but before I do, allow me to share a bit of a roadmap for how today's conversation will go. For the next 15 minutes or so, Professor Brown will provide his insights and analysis of this morning's jobs report. And then we'll spend the second half of our time together, starting right around 9:15 Eastern, fielding your questions. You are welcome to submit those anytime using the Q&A function at the bottom of your screen. You can also email your questions to me if you are joining by phone. My email address is mackenzie_babb@kenan-flagler.unc.edu. Again, that's for those joining by phone. I know that's a bit complicated, so we'll defer to the Q&A function at the bottom of the screen if you're able. We're going to aim to get to as many questions as we can before we wrap at 9:30 a.m. Eastern. So without further ado, it is my pleasure to hand things over to my friend and colleague, Professor Greg Brown. Professor Brown?
Great. Thanks, Mackenzie. So welcome, everyone. Thanks for joining us this morning. I'm going to run through some of the most important numbers out of the employment report and then try to cover what this means for current Fed policy and the broader economic outlook. So hopefully everybody can see that. So again, pretty strong employment report today. So here the blue bars are showing the month-over-month change in non-farm employment. So this is the headline employment number, clocked in at about 390,000. Let me make sure I'm in the right spot here. And again, that's a strong number. If we look at the 3-month average, that is trending down a little bit. That's the orange line there. But that's really because we just had exceptionally strong growth back at the end of last year and the beginning of this year. Not sure why my screen keeps scrolling forward on its own. These numbers of 400,000 or so we've seen the last few months, those are really strong employment numbers. If we think about, what sort of long-term average employment growth is on a month-over-month basis, it's in the 150 to 200,000 range. So, I'm going to stop being in the presentation mode here because I'm not sure why my thing is scrolling on its own. I don't want to do that. These numbers of 400,000 are roughly twice the long-run average monthly gains, and so we continue to see just really strong, really robust growth, even in the face of what would probably be considered labor shortages. Now that said, if we look at where total employment is relative to the pre-COVID peak, we're still a little bit shy of that. We're still about 0.8 million jobs below, but this isn't a sign of a weak labor market. It's really a sign of the fact that a lot of people have left the labor market and chosen not to return, either because they've retired or because of other situations that we're sort of pretty aware of. So, one strong way of understanding what overall labor market activity is to look at these very broad measures of unemployment. So, the headline unemployment rate, which clocked in at 3.6%, and that was unchanged, really tells us kind of on a narrow basis who was actively looking for work and not able to find jobs as a percentage of total people in the labor force. If we also kind of look at a little bit broader measure of people who we think of as marginally attached to the labor force, so maybe they're not looking for a job because they don't think there's good jobs out there, or they're working part-time, but they don't want to work part-time. So these are so-called U6 measure of unemployment. It's by definition going to be a higher number, but if we look at where that stands right now, it remains as it has over the last couple months at essentially all-time record low numbers. So, of course, this huge spike.
Professor Brown, I'm so sorry to interrupt you. We've had a couple folks ring in the chat that they're having trouble seeing your graphics. Is it possible to try presentation mode again, just to see if we can get that bigger visual for folks?
Yeah, let me do
Great.
that.
Thank you so much. Hopefully that's better for folks who are viewing.
Sure. Yeah. So I'll just go back and say again, just to recap, we're almost back to where we were with the overall employment, even though the labor market's quite strong, because there's been a decline in labor force participation. We're still not back to the full employment level. But when we look at this wider measure of unemployment, we're sort of at again, historically low levels. So, of course, going back to this labor force participation issue, there has been a lot of dynamics around the pandemic in terms of who's participating in the labor force. And what's really key here in terms of where the economy is headed forward is what labor force participation is among the kind of most active and most productive parts of the labor force, and people clue into this 25 to 54-year-old age group. And it did dip during the pandemic, but it's really snapped back to almost the average of where it was over the last 20 years or so. So there has been a decline in sort of broader civilian participation rate that hasn't snapped back as much and isn't near these historically high levels. But when we think about labor force participation among this key group, 25 to 54, it's basically back to where it was. Of course, earnings are really important. Average hourly earnings have continued to be really strong, again, by historical standards. So growth, it's in the 5% annual range in terms of average hourly earnings. However, the downside to this is that the inflation rate has been even higher than that. So if we look at the real purchasing power of consumers, we see that it's actually declined because inflation has been higher than wage growth. And then one final slide I want to share with folks is that when we look at the total number of hours worked, so this is essentially the number of people times the number of hours that are being worked on average, it also remains at a very high level. This maps in very closely to the overall growth rate for the economy. And if we think about sort of mapping what we know about income growth, overall labor market activity into the types of numbers the Fed is looking at for GDP growth, we're predicting probably around a 7% GDP growth rate for the second quarter, given the labor market data. Again, this isn't exactly a one-to-one mapping between hours worked and wages and what happens to GDP, because there's sort of broader things that show up in GDP, but it tends to be a very good rule of thumb. So we're expecting, after kind of a weak first quarter of GDP growth, a very, very strong second quarter of GDP growth. So I think overall, almost no matter how you cut the labor report today, it's quite a strong report. That said, it's a report that's probably largely in line with expectations. So the numbers that printed for unemployment, for job growth, for average hourly earnings, these are all sort of largely in line with expectations that the market had. And if we look at the market reaction when the employment report came out, stock market was already trading down slightly in the futures, and it's kind of stayed there. The bond market doesn't seem to have reacted too much. Yields are up slightly. So even though it's a very strong report, it's a report that was sort of largely in line with expectations. So I think the bigger question here is, what does this mean for Fed policy? That seems to be what people are really talking about a lot right now. We've seen discussions this week about what the path of interest rate increases will be. So I think everyone is expecting the Fed to raise rates this year, and it's really just a matter of how much and when. There's I think a consensus view now that the Fed will raise their Fed funds target by 0.5% or 50 basis points at each of the next two FOMC meetings. If we look kind of longer term out, what expectations are, there is sort of a long run expectation the Fed will get to about 3% by next February, if we look at the futures market for the Fed funds rate. So maybe we kind of take that as a benchmark and we think, okay, 3% is sort of what the general consensus view is about the Fed funds rate. different ways to get there. Maybe we get there through 4 half-point increases, or maybe the Fed raises by half a point at each of the next 2 meetings, and then sort of slows down or takes a pause and raises by a quarter point for the next 4 meetings. But in many ways, I think 3% is this number that's being held out there both by markets and by sort of Fed watchers is sort of a reasonable expectation. Now, that said, there is a large disagreement as to what the possible range of outcomes are for Fed policy. There's, I think, legitimate case to be made both for lower Fed funds below 3%, so that is the Fed not increasing all the way up to 3%. And there's also a strong case that can be made for even a higher rate. So let's start with the case for lower rate. I think the case here really revolves around inflation having peaked, and Fed officials are reluctant to say that inflation has already peaked, though we do seem to see at least a moderation in the recent data. But if inflation has peaked and starts to moderate fairly quickly, that's going to be a good sign for a lower trajectory for the Fed funds rate. If we see employment growth slowing, so probably needs to slow to rates well below what we've seen currently, below this 400,000 monthly rate. It doesn't have to go negative, but if it were to slow down to say 200,000 on average over the next few months, and if we also see more entrants into the labor force, so more than the 330,000 that we saw in May, that's also going to be a good sign. And that in some ways would be the ideal situation for the Fed. That would be the so-called smooth landing for the economy, where labor markets sort of normalize, and they normalize by continued job growth just at a slower rate and by more people coming into the economy. That's going to really ease some of the concerns about an overheating economy. Of course, supply chain issues are also feeding into inflation. So if we were to see better than expected news in terms of what's happening in China, what's happening global energy markets and fallout from the Russian invasion of Ukraine, if those are substantially better than current expectations, that's also a good case for a lower Fed funds rate. And then I think finally, we look at real wages, right? So I already mentioned in the presentation that while real wage growth has been strong, let me rephrase that. While wage growth has been strong, real wage growth, that is inflation adjusted wage growth, is negative. So the real purchasing power of consumers currently is declining on average. And so that's something that just can't happen with a growing economy in the long term. There's some notion that the households still have sort of residual excess savings that's letting them get through this period of low real wage growth. But that'll run out at some point. And there was a report this week that came out of JP Morgan that suggests that at current rates, by the end of the year, the households will have sort of used up their excess savings. So maybe the last case for a lower than 3% peak in the Fed funds rate would be that Fed action has already started to have an effect. So for example, we certainly know that mortgage rates have increased quite a bit, that they're up above 5% now. That seems to be having some cooling effect on the housing market. So if we can continue to see that sort of broader current impact from higher rates slow the economy down, then the Fed may not have to do as much. So that's the case for lower rates. What's the case for higher rates? Well, in some sense, it's the opposite of all those things, right? It's that inflation maybe hasn't peaked or won't moderate very much. It's that employment growth continues to be super strong. The supply chain still is a mess, right? And wages are continuing to grow, even if real wages are negative or growing at a negative rate. The fact that wages are still growing is going to continue to put upward pressure on prices, because that's higher nominal spending power by households. So the case here is maybe in line with expectations for even higher rates if we look historically. So there's rules of thumb that that academics and policymakers have proposed. So the most famous one being the Taylor rule, where you sort of put in inflation targets and historical relationships between interest rates and inflation to give you a guide for what Fed policy should be. If we take sort of an off-the-shelf Taylor rule right now, it says that the Fed funds rate should probably be close to 9%. I mean, that's a huge number, way higher than what people are predicting, unrealistically high. And there's reasons we might think that it's an exaggeration because inflation will moderate or rates don't have to go as high as they have historically. But still, there's this case that the Fed is behind the curve. The Fed has just started to tighten monetary policy, and that there's still a lot of stimulus in the system from quantitative easing that is yet to be removed. So, if I were to take a stand on this, I think I'm going to take the over. I personally believe that rates will probably climb to something closer to 4% in 2023. That's again above the 3% kind of current expectations of the market, well below what mechanical rules of thumb would tell us based on history. But nonetheless, 4% is above the kind of 3% expectation. The wild cards out here, I think, are that there's some parts of the credit markets that think that the Fed could overshoot. So, for example, they could raise rates so far that it would send the economy into a recession and then have to back off those. And in addition, I think there's a real concern about how the Fed will manage what it is going to become quantitative tightening. So shrinking their balance sheet, letting bonds mature, so that the stimulus that has been important on the monetary side from quantitative easing could potentially result in a significant drag on the economy. So in some sense, we think about Fed policy as they have a gas pedal and a brake pedal, which is the Fed funds rate. But more recently, they also have sort of this other lever, think of it as an emergency brake, which is the quantitative tightening tool. If they were to significantly accelerate balance sheet reduction, this would be another way to slow down the economy. But the Fed's going to be careful not to stall the engine, to keep on with the analogy. There's a real concern about exactly what the trajectory will be for the economy. And if it looks like things are going to stall out, I think the Fed will take a pause. They will either lower the increases in rates from 50 basis points to a quarter, or just skip a meeting until they have more clarity in terms of what's happening with the economy. So, so with that, I think we'll open it up to Q&A, and Mackenzie, I'll let you moderate that.
That sounds great. Thank you so much, Professor Brown, for sharing those key findings and your analysis of the numbers that we're seeing today. At this point, I just want to remind everyone who's joined us that you are welcome to submit your questions anytime using the Q&A function at the bottom of your screen. We've already had a few submitted, and we'll be starting with those, but there's still time, so please submit those questions as you're able using that Q&A function at the bottom of your screen. For those joining us by phone, again, you can email me your questions. My email address is mackenzie_babb@Kenan-Flagler.unc.edu. Professor Brown, our first question today comes to us from Linda Sanders. She asks, why is the labor force parsed to the 25 to 54 age group, especially given there are many in the workforce who are beyond that age group?
Yeah, so obviously there's folks younger than 25, the kind of 18 to 24 group, and then there's the kind of 55 and over group. The reason that people kind of clue in to these prime working age workers in the 25 to 54 group is, first of all, they're the largest group. They're the most reliable to work in the sense that the participation rates are very high among that group. They're least likely to, say, go into early retirement or want to work part-time or be in school, if we think about folks that are younger than 25. So it's not that people outside that group aren't important. It's just that if you want to clue in on kind of what this kind of core group of workers are doing that are sort of fundamental to the economic growth of the economy, that's the group that tends to be historically most important for predicting what's going to happen to the economy.
Great, thank you for that, Professor Brown. Our next question came in from Robert Sheehan. He posed the question, how much of the labor force is off the books now versus pre-COVID?
Yeah, I mean, that's a really good question. There's certainly been structural changes in terms of how people work. There's different ways of getting at the employment data. So what the Labor Department does is that there's two surveys. One is the household survey, where they like literally contact people directly and ask them, are you in the labor force? Are you looking for work? Are you employed? That's how we get the unemployment rate. And then there's the non-farm payrolls number, which comes just from companies and tells us the number of people that are working. So, it certainly could be the case that there's people who are working informally, so they're not going to show up in this non-farm payrolls number. The hope would be that when you call them up and ask them if they were working, they would, still show up in that kind of broader measure of the so-called household survey. Now, the reliability of those statistics has gone down quite a bit for a variety of reasons. One is just because people don't answer their phones anymore. In some sense, it's harder to do those household surveys, and so we know that the reliability of some of the statistics has gone down. That said, if you look at the trajectory of employment from both the household survey and the payroll survey, they've mapped pretty closely recently. And the other thing is that they're both just off the hook, right? In terms of where employment stands relative to labor force participation. I mean, it's hard to find an employment measure that doesn't show the labor markets being extremely tight right now. And that's, if we look at job openings versus job people seeking work. I mean, it's just, everything. The new claims for unemployment insurance, just about every labor market indicator we look at right now shows labor markets at a very, very tight level.
Great, thank you so much. Our next question came in from David Mildenberg. He asks, does 4% interest rate that you suggested have significant implications for the housing market over the next year or two?
Yeah, so if we think of this being about 1% higher than current expectations, so you can think of mortgage rates as perhaps being another percent higher, so a 6% mortgage rate, which if you look at a long history is not a high mortgage rate, but if you look at recent history over the last 15 years or so, it is a high rate. And I think part of the reason we've seen so much home appreciation is because mortgage rates have been low. It's made housing very affordable. So moving a mortgage rate up to 6%, that will have a significant effect in terms of who can afford housing, or what households can afford in terms of housing. So I do expect it would lead to a cooling of price pressures in housing. Now, that said, there is without a doubt a overall shortage of housing. So I don't think there's going to be a collapse in the housing market. There's just such high demand for single family and multifamily housing right now that I think it'll just lead to less price appreciation rather than a collapse or a decline in prices like what we saw during the global financial crisis.
Great, thank you. I know I am certainly glad I refinanced when I did, so hope others did as well. Our next question came in from Scott Schwartz. When the government calculates inflation, it seems that purchasing housing is not included in the inflation rates. Many homeowners have doubled and sometimes tripled the value in their homes, but inflation has not gone up 100 or 200% over recent years. Why did they ignore housing purchasing costs?
Yeah, so the way that figuring out what the cost of housing is difficult because in some sense, if you think of being a homeowner and the price of housing goes up a lot, you're not going to be directly affected until you buy another house and pay a higher price for a house, right? So you don't want to look at just what the current cost of the housing stock is and trying to figure out what the current cost to a household is on a monthly basis for housing. I mean, housing is the largest component of CPI or any of the consumer inflation measures. And the preferred method for doing it is looking at owner's equivalent rent. So the idea would be, well, let's look at what would happen to the cost of your housing if you had to rent your house rather than owning your house. And that tends to be smoother. It reacts less rapidly. It reacts to what's happening in the rental market. And there's not always good comps, right? Because the rental stock is quite a bit different than the owner occupied housing stock. So sometimes it's hard to get a good read in terms of what's happening to people who own their homes and their cost of ownership. So it's smoother. It tends to be lower. It tends to move with a lag. That said, if we look at the contributions to inflation, increasingly there's a large component that's come from housing, right? And I think this is a real concern to the Fed. I think it's part of why people are so concerned about the Fed being behind the curve, is that because there is just a lot of momentum behind owner's equivalent rent. It's going to tell us with some degree of certainty what's happening to inflation over the coming 6 months or so. So yeah, it's a complicated issue. It's one that I think is it's a weakness of all the inflation statistics, because housing is so big and it's so hard to measure. The cost of housing has gone up. It's likely to continue going up, and I think that's a real concern for the Fed. Maybe I'll point to that as another reason why I'm taking the over on where the Fed's going to stop.
Professor Brown, we've had so many great questions come in. I think we've only got time for probably one more, and so we'll make it a bit of a lightning round before we wrap. Brian Sanders, I think it's Brian Sanders. I can't see the full name, so apologies if it's a Sanderson. But Brian asks, are historical trends as relevant given the global impact of climate change, overpopulation, massive population displacement, et cetera?
Yeah, I mean, clearly there are these long-term secular trends in lots of things. I mean, maybe the most important for the economy is what's happening with things like global trade, energy, climate, the aging of workforces in many developed economies, including the U.S. I mean, there are certainly these long secular trends. I mean, the good news in terms of economic forecasting is you kind of know what those are, right? In some ways, they're fairly predictable, so you can build them into models fairly easily. And so something that's going to unfold over a 30-year period is going to be less of a surprise than something that happens as a big immediate shock, like a pandemic or a financial crisis or a war, right? And even in terms of a financial crises and war, we have some guidance based on history for what's going to happen. What makes the pandemic so unusual is we just don't have good economic data for something that mirrors what's happened with the pandemic. So it's very, very difficult to sort of take history, say, okay, here's what's happened, especially with things like the labor disruptions in the labor force and how people are working, and see what that's going to mean looking forward for the economy.
Thank you so much, Professor Brown. And I know that we are right at time, so we're going to wrap things up here. I would like to thank you again for sharing your insights, and thanks to all of our participants for submitting such excellent questions. I am so sorry that we did not get to all of them. Please know I would be happy to connect you with Professor Brown. If you would like to continue the conversation, you can email me again at mackenzie_bath@kenan-flagler.unc.edu, or you can email my colleague Rob Knapp, Rob_Knapp at Kenan-Flagler.unc.edu. We would be happy to connect you with Professor Brown or any of our slate of experts to continue the conversation. Thank you again so much for attending today. We invite you to learn more about our areas of research focus and expertise by visiting our website at kenaninstitute.unc.edu. And of course, invite you to join us once again next month when we gather to discuss the findings of the next jobs report. I believe the date on that is July 8th. I believe that that's right, but we'll be in touch with email communications between now and then. So thanks again so much for joining us, and take good care.